And because of crimes like this, I, as chair of the Congressional Asian Pacific American Caucus, or CAPAC, urge the committee to undertake this hearing because the Asian American community has reached a crisis point that cannot be ignored.
And Atlanta Mayor Keisha Lance Bottoms said that regardless of the shooter's motivation, quote, "it is unacceptable, it is hateful, and it has to stop," end quote. AstraZeneca's COVID-19 vaccine is getting the green light from the European Union. The EU's drug regulator says the vaccine is safe to use and that the benefits outweigh the risks. Several of Europe's largest countries have suspended use of the Astra shots over reports of blood clotting. Italy, Luxembourg, and Slovenia say they will resume giving the Astra vaccine tomorrow. The House of Representatives is set to vote today on 2 immigration bills that could provide a path to citizenship for millions of people living in the United States without legal status. The bills deal with farm workers and young undocumented immigrants known as Dreamers. Democrats had hoped to offer up more ambitious legislation, but that's disappeared with a surge of migrants who have arrived on the southern border. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
2 p.m. in New York, it is 6 p.m. in London. Live from Bloomberg's World and European headquarters, this is Bloomberg Markets The Close. I'm Caroline Hyde.
I am Romaine Boston.
I'm Taylor Riggs.
Love the enunciation. Risk assets, guys, they take a hit. The S&P 500 drops from a record. Big tech takes the hit. As the market digests the Fed's commitment to let the economy and inflation run hot. Bond yields spike, the Dow fights on as higher as the banks benefit. Romaine with the value versus growth tug of the war. Taylor on those borrowing costs. We have got you covered. Meanwhile, oil is extending its losing streak, crude falling more than 6% as short-term demand concerns and a rising dollar. They collide to cause the biggest intraday drop since October. And Goldman gets groused. 100-hour work weeks. We see declining physical mental health, pushing 13 first-year analysts to put their grievances in a presentation that causes a stir across social media and reportedly has the Wall Street firm enacting new measures. We discuss how the bank is apparently listening to their concerns. All that, so much more coming up this hour, Romaine.
Yeah, let's check in on the markets. And we're actually going to start off today, believe it or not, Caroline, with the Dow.
What?
Never look at the Dow.
I thought it was bonds.
I know. It's one of the only major indices actually in the green here on the day, of course, holding over that 33,000 level. That is a record high. But what's keeping it in the green here? I mean, we've got to kind of peel under the hood here. And you're looking at names like United Health and really a lot of the banks, Goldman Sachs, JP Morgan. Keep in mind, 16 of the Dow members are still in the red here. And that's kind of the story for the broader market here, which is everything in the red. You take a look at the NASDAQ, specifically that NASDAQ 100, 87 of those names in the red. At one point, we had something like 95 of those names in the red. Apple, Tesla, Amazon, basically all the growth of Momo names, they're all moving lower here. And the only thing really getting the bid is some of the cyclicals, and that really gets you more into the mid-cap space, and then some of the financials. That's pretty much it. There's your dollar index. And wow, we're going to talk about that 10-year yield. Woke up this morning with a 175 on my screen.
The bond vigilantes are back. The bond vigilantes are back. Let's take a look at some of the economic data. Caroline, really, as we start out first and really set up the day here. Well, jobless claims coming in higher than expected, a one-month high, 770,000. Continuing claims falling, but also way higher than expectations. We diverge from jobless claims. I just want to quickly mention the Philly Fed Index. Prices paid, the highest since 1980, Romaine. That is what is driving the bond market. Flip up the board.
I'm the only one old enough on
Prices
the set to remember these,
paid. Right? No comment.
Never
bond
age
yields. Caroline, the bond vigilantes are back. We are back to January 2020 levels because that is where the 10-year yield is. Huge.
Huge. I mean, you have kept us so honest on where these yields have been heading. The rate of change as well is all important. Let's get more insight. Elaine Stokes is with us, Executive Vice President and Portfolio Manager at Loomis Sales, where she runs the firm's flagship bond fund. The best voice for today. Elaine joins us today from Boston. Elaine, what do you make of the ramp up in yields? What do you make of where the trajectory goes from here?
You know, it's really, we heard the Fed yesterday, right? They're pleading, I think, with the markets and asking for patience. And we expected this, right? We've seen moves in all the other markets, so you expected bonds to play catch up. And that's what we did. And now I think what the Fed was saying yesterday, what I'm saying to the market is it's time to slow down. You know, you just said we're back to 2020 levels. We are back to that time period before COVID, when we were in a very long expansion where the market, the cycle was moving very slowly. Then we went through this crazy speed up in the cycle, going through the downturn, finally getting ourselves back into the recovery. And we just need to understand that we need to have a little bit of patience, because coming out of this is not going to be a straight up shot. And I believe that's what the Fed was trying to say to us yesterday.
Yeah.
You know.
Yeah, and well, they said it. I mean, whether we want to believe it or how we interpret it, Elaine, I think is up for debate here. I do wonder, though, as a bond investor, sort of how you sort of structure your general investing strategy here in an environment where it does seem like Powell's going to keep his foot on the short end of the curve here. He's going to let the long end do whatever it wants to do. And I worry that some bond investors are going to get kind of stuck in between here.
Yeah, you know, so it's talking about how do you get defensive in this market, right? And, you know, people get defensive, investors get defensive in a lot of different ways. Our way of getting defensive in this market is really switching strategies. We're credit investors. And, you know, what part of the bond market has done well year to date? High yield. Yeah. And it's because of that extra coupon, that extra yield.
Hello. Welcome again. Today we have these two from last week, the dollar and the Swiss franc and the dollar yen here. Okay, as I said last week, let me show you. If goes here around this area, we will place another sell order. As you can see here, we have another sell order. When this will touch here and go below this level, we will close this trade. Okay, the same thing here. As you can see on the US dollar Japanese yen, we place another sell here, and when it will go below this level, we will close this trade. Okay, here as you can see is the resistance level and the supply zone here. Let me show you further. Okay, let me show you here. As you can see here, this indicates that we are in the supply zone. Okay. On the USD Swiss franc, let's see. It's the same thing. Here is the indicator that we are in the supply zone, and that's why we place a sell order here. Okay. Here we have the oil. As I said last week, it's in a downtrend, and that's why I place a sell order here. As you can see, it goes pretty much low here. I expect this one to go around $50 per barrel or less. We will see in the future what happened with this one. Okay, we have new here. We have the natural gas. Here, as you can see, I place a buy order because we are in the demand zone here. As you can see, after a big drop here, it was a big candle here, a big up candle here. Let me show you on the daily chart. On the daily chart, As you can see here, it's starting to form a candle that indicates we will enter in the buy zone.
I'm not sure the exact number right now, but call it 13 trillion of negative yielding debt around the world, and bond yields having moved up as much as they have in the U.S. I think there's buyers out there.
Today was the interest rate on the USD, on the dollar. Powell said that he will keep on change the interest rate at least till 2023. That's why the dollar is weak. That's why the dollar is weak. And it will be weak at least for a week from now on. At least next week it will be weak. Okay. Stay with us. Enjoy the stream, and we will came with updates.
Sales. Now, while she was speaking, we did have some breaking news crossing the wire. This for our folks over there in France, over there in Europe. The French Prime Minister has announced a Paris area lockdown, of course, related to the COVID-19 pandemic here. We're going to keep an eye on that and find out a little bit more about what that means for our folks out there in Paris. Now, coming up here, a lot more on the show. A big down day for WTI crude, down as much as 6% at one point here on the day. We're going to find out why. And Brazil taking a hike. The U.S. holding interest rates steady. Brazil's central bank taking a swift change of course. We're going to discuss the latest as what's going on down there. And Goldman Sachs bankers still heading to Florida. We're going to talk about how the new management union in the Sunshine State gaining momentum. All that and more coming up next. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Everyone but Romaine believes in a global reflationary environment. Take a look on a global basis, the 2s, 10s. Australia, Germany, the US, Japan, the UK, all sort of getting a yield curve steepening as we price in higher growth, higher inflation, higher reflation. You go longer out in the US to a 30-year. the highest since July of 2019. It really seems like the calm of yesterday sort of waking up to a bond rout this morning. The calm of yesterday coming from Jay Powell. Take a listen to what he had to say.
The state of the economy in 2 or 3 years is highly uncertain, and I wouldn't want to focus too much on the exact timing of a potential rate increase that far into the future. So that's how I would think about the SEP.
Let's bring in our own Bloomberg's Mike McKee. Mike, it seemed like yesterday everything was calm, and then we woke up today and we decided we believed in inflation again.
Well, the market believed in inflation again, and so had to reprice. That's the problem that they had, is they went into this thinking perhaps the Fed means it, perhaps they don't, and Jay Powell apparently convinced them that they do mean it, and they're going to keep rates low for a very long time, even if we see unemployment fall to 3.5%, and they're predicting 6.5% growth for the year. Now, that's a formula in the past that's always produced inflation, but the Fed says we're only going to have 2.1% inflation in 2023. That's the year they're supposed to lift off, so maybe they don't even then. The market's going to price in longer-term inflation just to cover their risk.
Yeah. So now, I mean, we're talking a lot about the Fed, but a lot of people are now looking to other central banks and what they may or may not do, particularly the Bank of Japan and I guess at some point the ECB. What about the Bank of Japan?
Well, the Bank of Japan coming up overnight tonight is expected to not do anything, but they did an interesting experiment. They put together a report on what would happen if they took their already negative 10 basis point base rate down further into negative territory, and they're going to release that.
That's one way to go.
I guess the idea is to scare the markets and keep rates lower. They are also talking about tweaking some of their monetary policy procedures, some of the things that they buy. They're not expected to follow through, but just sort of lay out this roadmap just in case they need it. The Brits did the same today, too.
I heard. We have a Brit on the show.
Yeah, so
Caroline,
there
you
she is.
Down on
okay, the day after St. Patrick's Day, she's in green here.
I know, I'm a little bit late to the party sometimes, but Mike, it's interesting that you're saying that the Bank of Japan is trying to scare investors. We've got the Fed trying not to scare investors, and meanwhile, you've got the ECB being scared by investors, and now the BOE seems to be going sort of in the middle with the Fed, right?
Well, the Bank of England is looking at the same things that the Fed is looking at. The United Kingdom doing much better with vaccines and the economy in bad shape. So they're feeling like growth can come back, but we just need to leave rates low. They had talked about the idea of negative rates, but took that off the table. But they still have this quote in the monetary policy report today on their decision where they're saying the committee does not intend to tighten monetary policy, at least until there's clear evidence that significant progress is being made in eliminating spare capacity and achieving the 2% inflation target sustainably. Now, if I didn't tell you that was the Bank of England, you would have believed that that was Jay Powell. They're reading from the same book at this point.
Romaine doesn't believe in inflation. My airline prices are going up. My avocado prices are going up. My nut pod creamer
You're such a millennial.
thing is going up.
Your what creamer?
The nut pod creamer, vegan coffee creamer.
Oh, good grief.
Is it going up or not? Do we have inflation or not?
We have inflation. I mean, you look at computer chips. They're going up in price. You probably don't buy. Well, you do buy those, so you just don't know it. And other things. But we have supply chain shortages that are causing a lot of these problems. And we have some prices that are going to come up because people want to make their money back that they lost. But it's not abroad.
Yeah, definitely, definitely pockets of inflation there. Our international economics and policy correspondent Michael McKee there, given that. And we will be talking more about central banks, including Turkey and Brazil, in today's EM Action. That's coming up later this hour. But before we get to that, we're going to talk about Taylor and her pistachio milk. And we're going to talk about oil plunging, short-term demand concerns, and a rising dollar, causing the biggest intraday drop in crude since October. This is Bloomberg. is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
Criticisms that are fair and rational and fact-based would of course be well taken, because in a democratic society, one needs to take those on board and then analyze it in order to formulate the policy.
We're seeing some serious drops in oil prices today. Come and take a look really at the 5-day loss. We're now down for 5 straight days. This is the longest losing streak that we've had since November 2020. And at one point, the biggest intraday drop that we had seen all year as well. I mean, we're getting some big concerns about inflation that's weighing on broader sentiment, and really concerns too about demand in Asia and Europe as well. Let's bring in Andres Guerra-Luz for more on this, who's been covering this. Andre, what do you see right now as the key driver of prices lower?
Hi. Yeah, since, even though there's, a variety of factors weighing on prices, I think, among the most immediate is just the change in near-term trajectory for the global demand rebound. Heading into the year, the vaccine breakthroughs and kind of the positive news flow around economies opening up had, led prices to break out of their months-long trading range. But lately, some of that's being tempered with news flow out of Europe that there's lockdowns and, just continued, bearish headlines about vaccine shortages.
You say that, and we've just had the latest headline about Paris going back into lockdown, France having to realign. So clearly, you speak to exactly what we're seeing. Talk to us about the market structure right now. You say that's weakening. How?
Sure. So the most prominent example is that in WTI, the nearest prompt spread, which is often a signal of whether there's concerns over oversupply or tightening, had flipped to contango, which is very bearish for crude prices. And even with the Brent prompt spreads in a more bullish backwardation structure, those have eased quite a bit since even just the beginning of this month. The Brent near-term spread is now just at 25 cents in backwardation versus highs earlier.
Yeah,
this year.
Andres, it seemed like a few weeks ago, a lot of people were talking about sort of the reemergence of U.S. shale, the idea that a lot of folks were ready to start drilling now that you had prices back above $60 a barrel. Is that narrative still in place?
It's definitely looming out there. Whether or not it comes back in full force is still a question, because a lot of those players do have investors pressuring them for capital discipline, but whether or not it comes back in full force is still has yet to be seen. Definitely at these price levels, it seems like it would be attractive, but I think further down the road it will become clear whether or not that will make some of these players kind of ditch their capital discipline promises and just start pumping more oil.
All right, Andres, Bloomberg's Andres Guerra-Luz, of course, giving us that breakdown. Let's get over now to Taylor for the Business Flash headlines.
Yeah, let's do it. We're going to start with the U.S. hiring spree. I mean, really set for an epic one as the pandemic recedes. There are signs, well, it might already be underway. Bars and restaurants across the country adding 300,000 jobs in February. That was the first substantial increase in 4 months. Goldman sees the unemployment rate falling from 6.2 in February to 4.1% by the end of the year. And Goldman Sachs also planning to move part of its asset management team to Florida. It's gaining momentum. Bloomberg has learned that the firm is discreetly seeking volunteers for the first wave. The initial group could be made up of a couple hundred people, with more to come later. And 100-hour weeks on the job, declining physical and mental health, no time to eat or shower. Those are among the complaints of 13 first-year analysts at Goldman Sachs. This is according to a survey that has been circulating on social media. Bloomberg has learned that that's prompted the Wall Street firm to enact some new measures. The analyst suggesting solutions, maxing out the work week at 80 hours. Caroline, your work week also 80 hours.
Oh, not even close.
No, I mean, to be having to go to bed on average at 3 a.m. And the stat that caught me the most, 77% of it's only 13 strategy analysts, we've got to put it in perspective, but of those 13, 77 said that they were a victim of workplace abuse. I mean, no wonder Goldman's looking at this. This is incredibly bad. I mean, public relations for one, but just work ethic, expectations. It blows your mind, Romain.
Yeah, and it's a serious issue. I thought what was interesting about it was really the presentation that they all put together. I mean, this is like a professional, basically analyst deck that you would put out to, recommend, the latest stock here. So they really put some thought into sort of making their case, I guess, in the only way that a Goldman Sachs analyst can make that case, I guess, which is through sort of that traditional deck. And,
Romain, there's a please fix, though, on slide 10.
Okay. I don't know what that means.
Always
I
got
didn't
the
go
focus.
You'll find out.
All right.
Okay, I'm back. I want to show you here on the natural gas something. If the price will drop again on this area, I will place another buy order. Let's see on the daily. Okay, on the daily, the resistance zone, it will be around here. But also here, as you can see, it's demand zone here on this level. If the gas will down, it will be down here again, will drop here, I will place another buy order.
I'm Mark Crumpton with Bloomberg's First Word News. A setback in France in the fight against the coronavirus pandemic. The country is imposing a lockdown and
conversation with your team more recently for the quarter. And what I found fascinating within that, from the highlights that you offered to me, is that you had a conversation about an outlook with seemingly no economic downside whatsoever. Does that make you nervous at all, Bob?
No, it doesn't make us nervous at all. And if I think about today's FOMC meeting and the press conference, I think the Fed's in a great spot. The vaccines are rolling out. There's lots of fiscal stimulus in the pipeline. The reopening is on the horizon. I just hope they don't mess it up. And when I step back, by the way, I think we've done a lot of the hard work for them. If you go back to August, the 10-year Treasury was 0.58%. We brought that up another 100 basis points. If you look at real yields, the low was minus 1.125%. We brought that up to minus 0.58%. And by the way, we in the market did that while keeping financial conditions as accommodative and as loose as they've ever been. So my message is to the Fed is things are going great. Don't mess up all the hard work we've done for you.
What do you think messing it up would look like, Bob?
I think getting clumsy and getting sloppy and trying to force the normalization process. As I said, the markets have done some of that for them already and done it really without a tantrum. Sure, bond prices are down, but that's all part of the normalization process. I think they should step back. They should adjust their economic projections a bit higher. I wouldn't mess around with the 2023 dot. I'd leave it where it is, and the supplemental leverage ratio, keep it where it is right now. Why try to telegraph to the market that you're ready to start any kind of tightening process?
Jim, I'll start with a simple one, a short one. How much oxygen is left up here as yields drift higher?
I think a decent amount. You know, based on what Powell said yesterday, where he seems to be inviting inflation and is holding the line. Look, I saw yesterday's press conference and yesterday's meeting as a test of the Fed's credibility. In the face of better data, better jobs, and everything else, they held the line and they said, we're going to stay on hold. Nothing's changing. But you know what? That's not their hardest test. Their hardest test is going to come in 3 months' time at the June meeting when they have to release another summary of economic expectations and a summary of economic projections. And then they're going to have a monster 2Q, right? You're going to have million job growth numbers that are going to be coming out. And you're going to have probably double-digit 11%, 10% growth in the second quarter. I'm seeing some estimates. Then how are they going to hold the line at that point? And I think that if they do, and it's seemingly that the Fed is geared to actually hold the line of being patient and not moving until 2024 or late 23, then that's going to stoke inflation pressures even more. Plus, you're going to get core PCE inflation figures that are going to reach probably by the April or May period about 2.6%. So you're going to be at a lot of these key thresholds, and then they've got to roll into their June summary of economic projections and say, we're going to still hold the line. That's what the market's going to be betting on. Will they be as good in June as they were in March?
Jim, your charm is not only as a strategist, but also the joy of losing money in a bond bear market. What is the behavior of institutions and, frankly, foreign investors as well? Is price lower, yield higher? Do we get convexity where we get acceleration through a level of 2%, acceleration through 2.25%?
Yeah, look, as you point out, this is a tough period for the bond market. Yields are going up. They're going up very, very quickly. Duration in many of the indices are very long, so you're getting negative total returns in many of these.
Shocked.
But yeah, shock. But here's the thing: is that after the first half of the year, I call it peak surprise. So we've been surprised by better and better data throughout the year, and we're going to continue to get some good data. But at some point in the second quarter, I think we hit that peak. And at that point, the hard work really starts to begin, where the year-over-year measures for inflation start to fall, that the jobs rate becomes into some form of normalcy. We're still playing catch-up. And at that point, I think that bond yields can actually start to settle down. Doesn't mean that they drop a lot, but that's where spreads, because don't forget, credit spreads are still holding up pretty well. So if you're a bond investor and you can strip out the interest rate risk, strip out the duration risk, but just play for the credit spread, just play for that excess return, you could actually do pretty well because spreads, high yield spreads, are still tighter on the year. And eventually, you were mentioning emerging markets. Emerging markets, once yields stop rising in the U.S., and they will at some point, I think they have further to go, maybe up towards 2%. But once they stop, then you start to get this risk parity normalization starts to come in where people can start to balance their portfolios with fixed income and other assets. And I think it's actually healthier for the market. But we have to get through this painful period first, and that's what we're going through.
2.4% this year. Do you believe that? Do you believe the market will buy the idea of inflation at 2.4% this year that then drops off to 2%? And are we going to have a fight between the markets and the Fed?
Well, I think that's already started, and you know, when I look at the data, you know, it is apparent that because of the base effects, that we're going to get, you know, a pretty significant rise in inflation in the near term. But a lot of the work that we're doing is showing us that in about, you know, 3 to 6 months, once we adjust for the base effects, that a large, you know, portion of the components in PCE actually turn negative. And so, you know, the pattern in history has been that after the end of a recession, which I think the recession is over, somewhere, you know, 12 months or so after the fact, that inflation actually declines after an initial surge related to the rebound. And I don't see any reason, Mike, why that would change. And so that scenario, you know, if I am right, fundamentally, the market is not discounting that kind of a scenario. And at some point, I think that we're going to have a pretty severe snapback in yields to lower levels.
We're moving away, at least for today, from talking about reflation to some of the concerns about vaccine rollout and some of the potential domino effect that could have. Does that change in any way what you're constructive on, or do you still just focus on reflation and actually the fact that we will see a recovery?
I think the focus still has to be on reflation. Even in a place like Europe, which is clearly lagging in terms of vaccine progress, there is some incremental gain every week in terms of the share of the population that is receiving shots, and the economy is still delivering better growth or better performance than most people would have expected a few months ago when the lockdown started. So I think the path is fairly clear, meaning it's up, and I do think that when Europe manages to catch up to the UK and US in terms of vaccinations, even if that's 3 or 6 months from now, there is going to be a boom in Europe in terms of growth, which is going to rival what you might see in the US. The sources will be different. It's going to be from easing of restrictions on activity in Europe as opposed to the US, which is much more about the fiscal impulse, but the end result in terms of growth could be comparable in the two parts of the world.
When you look at cross assets, what could the shock come from? And we talk about reflation day in, day out. We also talk about how that changes the 60-40 portfolio construction. But is there anything that you think could surprise us and actually, you know, change everything that the market has not thought of?
Well, I think it actually would just be an extension of the current preoccupation that the market has. The current preoccupation the market has is that inflation is going to move up. It's going to stay higher for longer than the Fed expects, and therefore not only is the Fed going to have to taper reasonably soon, but the Fed is going to have to tighten sometime in 2023. And we're fading that view in the sense that we think that inflation is going up, but then it's going to move lower in the second half of the year. There'll be no need for the Fed to tighten as early as 2023. But I think if there's going to be a surprise, it's going to be that the move up in core is longer lasting. It's more durable. It continues through all of 2021. And if that happens, not only is the money market pricing going to look fairly reasonable, but it's going to have to shift up even further over the next several months. So I'm really most concerned that this sort of temporary move up in inflation is not going to be temporary. That's going to be much more persistent and get the market much more worried on the bond side with the usual kind of casualties to the EM markets and to stock markets occasionally.
We're going to see a boom economy we've never seen. Supply's going to come on. There's going to be interesting original elasticities. Are we underestimating the earnings and cash flow boom to come?
Tom, I think we are. I don't see anything negative for the corporate sector or the private sector in the next year. Now I'm talking about we're coming off of a low base for some parts of that the private sector like hospitality and airlines. But I think we're dramatically underestimating earnings. There's a lot of money for consumption from the stimulus, plus as people go back to work. And, companies have had to pare back, and they've worked on becoming more efficient. And so that's good on one hand because it's going to help corporate earnings, I think, dramatically, which will support higher stock prices. But it's going to be bad news from the employment situation because a lot of the people that have lost their jobs, there are no jobs for them to return to. And I think that's exactly what the Fed's worried about. And so that will, feed back into monetary policy, which probably will continue to push earnings higher even into the 2023 or 22 and 23.
I would like to start by noting that it has been a full year since the pandemic arrived with force on our shores. Looking back, it was clear that addressing a fast-moving global pandemic. Okay, as you can see here, the oil is dropping more here. The natural gas is staying here for the moment. The dollar Swiss franc, it's reaching again this level, and the USD yen, it's still in the downtrend area. I think that's it for today. We will see you next week when we will do another session. Have a nice day. Bye-bye. Given us maximum employment and price stability. The economic fallout has been real and widespread, but with the benefit of perspective, we can say that some of the very worst economic outcomes have been avoided by swift and forceful action from Congress, from across government, and in cities and towns across the country. More people held on to their jobs, more businesses kept their doors open, and more incomes were saved as a result of these swift and forceful policy actions. And while we welcome these positive developments, no one should be complacent. At the Fed, we will continue to provide the economy the support that it needs for as long as it takes. Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful